Dan and DeGeneral DeFi of Rysk Protocol. That's Risk with a Y. Guys, how's it going?
Hey, hi Greg. Thanks for having us. All great. How about you?
Doing well. Crazy times. So for people viewing this in the future, we just had sort of a meltdown with FTX recently. This is highlighting the need for DeFi and good DeFi protocols, which you guys are running right now, which is awesome. Maybe we could just start with that. Maybe you guys could give us a brief background of Risk and how you guys view yourselves in the ecosystem.
Yeah, sure. Let me give you a bit of introduction. So we started Risk like almost a year ago now. So, it was probably like at the top of the market. And one of our idea back then, it was like most of the market and the yield and everything was going up in the same direction. So everything was highly correlated. Yield was very high. Everything was working back then pretty much in DeFi, right? But one of our assumptions was like, what's going on? What happened when, the market it's going down, it's not up only anymore? Like, do we still have the same returns? Is it possible to have that? And so we said, why we don't try to build a product for, like worse time, like more bearish time, where we can build some sort of uncorrelated returns. We were all big options nerd and we love options. So we said, we try to build a vault in some way that what it's doing, it's try to generate uncorrelated returns for depositors. So on one side, we have liquidity providers that deposit stable coin and they deposit into this vault that is called dynamic hedging vault. And what this vault is doing is actually trading options. And the way it's doing in a way where basically he also try to hedge himself to reduce the risk exposure. We try to be market neutral. So the vault, he knows his delta, he knows, it's gamma and so on. And they try to achieve at least a delta that is close to zero. So what it's trying to do, like every time we trade options from this vault, we try to rebalance delta if it's needed by also using other type of derivatives. So on the other side of the vault, we have traders. We have other protocols that they trade options with the vault. But on the other side, we also have few integrations with perpetual products, with Delta One type of products that we use them to hedge and rebalance this risk exposure. So that's a very high level overview of Risk and our first product that, as I said, is called Dynamic Hedging Vault.
That's fantastic. So where the sort of the DOVs that we're used to today before you guys came along is a typical sell a covered call, sell a cash secured put. Now you guys have like a delta hedged straddle position that essentially your vault will engage in. How are the delta rebalances triggered? Are those traders looking at sort of the outstanding net delta and there's an incentive to go ahead and trigger a hedge? How does that work exactly?
Yeah, so there is a calculation for the net delta, but when you're looking at delta broken across a few expiries, the expiries which are really close. So, for example, we have expiries coming on the 25th, 8 o'clock in the morning UTC. Those guys are right now, they're going to be either like, if they're out of the money, they're going to be zero. And if they're in the money, they're going to be one. And so like the changeability of those is usually not very much. However, if the spot price is very close to the strike price, those guys can flip flop between 0 and 1 really easily. So to try to hedge that is just going to cost a lot of money and doesn't really make a lot of sense if spot only moves, let's say, $10, $20. So in addition to looking at delta just as a kind of a net value aggregated across expiries, we also look at delta in the near term and delta in further out. And for the delta in the near term, let's say we brush over that. We let nature take its course. And for the delta that's further out, that makes a lot more sense for hedging, then that guy gets hedged. So out of the monies that are near dated, they don't need any hedging. In the monies that are near dated, they already have like a legacy hedge that's been placed on them. Ones that are flip flopping around about the money, it doesn't make sense to hedge them. And for the ones that are further out, like a month, 2 months, 3 months, and so on, then those guys have hedges which are rebalanced much less frequently.
That's super interesting. So short dated options that have a ton of gamma, the rebalancing costs are so expensive that we say, okay, let's just not worry about those and kind of hedge sort of the meatier options, where the delta doesn't change too much. Now, what is this typical sort of option strip of maturities that the vault will hold
So
or sell, I should say?
yeah, well, the vault can also buy back, but usually it's selling. So usually it's short gamma, and like often options are. It's more cost effective usually to let options run to expiry, because you don't have to cross the spread again with market makers, for example, in order to terminate those positions. And the longest dated we've done, Dan, if you can correct me, is around about 30 or 45 days to expiry.
That makes sense. Okay, so it's a kind of a mixture, a basket up all the way as far as 45 days out and as near as, weekly that's expiring tomorrow even type of deal.
Exactly. And the strategy tends to be like a mixture of we have clients that are buying options from us, and they come to us with the strikes and expires that they want, and we provide a price, and we trade on those. In addition,
to add on that, the general, you were mentioning like DOV, right? So right now we have some sort of like a few DOV basically trading with us. That's what the general was just referring to. So they come and say, okay, this is the strike price we would like to buy. This is like usually their weekly, as you know, they buy every Friday and they trade every Friday, right? And so that's, we have some clients like that right now buying from our DHV. Sorry, the general just wanted to add on that because Greg mentioned that.
Yeah, no, thanks for adding the color on that one. And then for the other side of the strategy is to sell vol and basically to sit on it. And this comes in two kinds of flavors. One of them is to sell, let's say 45, 30 day to expiry straddles. And then if spot doesn't move, that's great. If spot does move, then we probably would terminate the leg, assuming the volatility wasn't super high. We'd terminate the leg that seems to have lost most of its value by that point and focus on the remaining leg. And then if spot reverts the other way, then we can terminate that leg and effectively make most of the value of the straddle in about a quarter of the time. In the case where one side is terminated and the other side is not, then we tend to run that one to expiry. And then finally, we always keep a little bit of collateral, or rather quite a lot of collateral, for when things go bad. And when I say bad, I mean bad for everybody else. Volatility is spiking. When we see volatility creep past 100, 120, 150, and by volatility here, I'm talking about a net volatility measure, for example, the Derivs devol, the calculation of which is a smoothed average of the interquartile range of the 30-day implied volatility, for those technical nerds out there. And so when that goes past these thresholds, we have reserves to sell more, because volatility, when it spikes, doesn't tend to stay there for very long. So you need to act fast. But bearing in mind, you're entering into dangerous positions. So you want to do just a small amount that's manageable and wait for vol to come down and then terminate those positions. So one of them is doing, I suppose, it like a mean reversion or statistical arbitrage on volatility. And the other one is sitting on volatility and just collecting the daily thetas.
That's really good. That's fascinating. So when I'm thinking about, like, let's say I'm a user and I'm an LP, like, can you just walk me through sort of the interaction of how I would go from point A to point Z using your protocol?
Yeah. So for LP, we made it very similar to the experience that you learn from like DOV or like, some sort of full product from Rysk Finance or something like that. So as a depositor, you deposit USDC right now into the vault. So, two transactions. The first one to approve, as you all know, it's, DeFi and so on. The second one is just like basically deposit into the vault. After that, we deploy deposit basically right now weekly. So like right now we're doing every Friday. So every Friday, let's say you deposit on a Monday, We use your money on Friday. We convert that to shares representing your position into this vault. But from a user perspective, that's everything you have to do. So you just deposit, and that's it. Like, we do everything automated on Friday. We deploy the capital. And then what the user is doing, it keeps tracking of what's going on with this initial deposit. So it can go on his dashboard, see if the price is going up and making yield out of it. And then eventually in the future, when you desire, you can just withdraw from the pool. The withdrawal is a similar pattern. So you can basically initiate a withdrawal, like, let's say, today, and today is like Wednesday. And so on Friday, the capital will be available for the user. So as a LP perspective, it's pretty simple. Like, you just deposit, like what are we used to for like DOV product or vaults. Deposit, and then you just track your initial deposit and see how that is performing over time.
That's fantastic. And then what about the other side of the trade? What does that look like from a user's perspective?
Yeah, the other side is the more interesting and fascinating one. So the other side, we have different actors right now. So one, as I said before, is like DOV. So this is mostly like, integrations protocol level. So basically, they have integrations with us, they can trade, and the options, sometimes the options price there right now, because we are on the alpha version, is happening through an OTC. So we basically define the price and we do an OTC trade. But we are working right now on Risk Beyond. That is going to be the next iteration, and the price will be fully on-chain and fully automated. So on the other side, you can be a trader, you can be, an average retail user, you can be a protocol, whatever. What you can do, you can go and ask for a quote for different type, like, for different options. So like different strike, call, puts, whatever. You can ask for a quote, and basically the protocol is able to quote the price immediately, like in a, similar to an AMM type of product. And you can basically do the trade immediately there. So you check the price. If you're good on the price, you can trade. So this is more, experience optimized, obviously, for options. And so anyone can go there and trade options. Right now, we're trying to stick with, Friday expiries and the most common strikes. But potentially, because we are, this type of AMM, we can potentially also offer, some more exotic strikes or expiries and so on. Even though, like with the general is the quant side of the company. If you like, of Rysk, if you realize that, we discussing it makes sense, from business perspective, mostly because we think that, having the most of, common strikes is probably ideal. But so yeah, you can go there, basically have all the Friday's expiries, different strikes, and you can get a quote for basically trading any option.
That's fantastic.
To add on that, now we have ETH options. So options on, it like with ETH as underlying.
Very cool. And so recently we've seen a lot of turmoil in the markets. How has this affected sort of your guys' flow? Are you seeing like maybe a reduction in volume or an increase in volume? And how many total value lock do you have for LPs, and what kind of flow are you guys seeing amongst like the FTX meltdown and BlockFi and Genesis trading and all that stuff?
Yeah, so the TVL right now, it's capped, and because of the alpha, and because we just launched less than a month ago, basically, and we try to have everything tested properly. So we have 700K TVL. We reached that cap like in a few minutes, and we said, okay, this is enough. That's what we need for playing around and making sure the infrastructure is solid, the mechanism is solid. So out of the 750K, we've been trading like using mostly short options as collateral. We have like 150K collateral committed to basically trade options. So we're not 100%. We've been pretty conservative. In terms of volumes, as I said, because we're conservative and we try to use this, we didn't really have an impact, or we didn't see anything spiking or anything going down, mostly because, we are kind of limited on this capacity. But what we realized, for example, during the craziness around the FTX, especially the day when the tweet came out about this letter of intent from Binance, like, that was a crazy day. What happened, for example, we realized that some institutional actors, for example, were not able to trade, mostly because they had bigger, deal like to care at that time. So it was mostly like, just harder to work with institutionals, but because volatility spiked, on the other side was, like retail users were more interested in trading actually. So, like whales type of users that were pretty excited, because options are, as you know, like very good instrument when it's coming to those kind of days. Like you can use them to hedge or you can use them to speculate. And when you have those days, like you have a lot of users that want to hedge themselves, they want to buy insurance because they think, okay, this is going to be so bad. But you also have a lot of users say, okay, let me just buy a bunch of puts. This is going to be crazy. Like, I'm going to make out of money out of speculation. So those days are actually the exciting ones when you're actually working and trading with options. But yeah, I mean, for us, honestly, didn't really have a huge impact because, as I said, we are still limited on size, and because of the alpha version of the product that we have, it's pretty much the same that it used to be the weeks before.
Very cool.
Just to quickly add on that, the FTX fiasco was a boon actually for us in a couple of different ways. The first way was it accelerated our integration with kind of a major CeFi exchange. So we were able to, rather than hitting market makers on the very, very limits of the bid offer, and even sometimes quite far outside that, to be able to be getting hold of positions or selling positions inside the bid ask. So for us, that was enabled us to make extremely good value trades compared to what we've been doing previously. And as Dan mentioned, that was in part driven by the inability, unwillingness, or sort of it's not able to really do trades from the market makers. But I just make a note on that one. Market makers were quite happy to have positions that we had with them terminated. They just weren't very keen to take on anymore. So make of that what you will. But so getting better prices, getting access to an exchange, and that sort of stuff was great. It also enabled us to test out properly the strategy of buy high, sell low, which when you're short gamma is actually quite rare because normally you're doing the opposite. But I'm talking, of course, about selling volatility high and buying it back low, and that's done very well for us. Well, we had just a 20 ETH limit on the exchange, and that has made about 5.5 going on 6% in just a few weeks since then. So that's sort of 80% APY just on that. Of course, it's been an exceptional period for that one. So yeah, but rather quite happy about that one. The second boon is that people are starting to realize the emperor is wearing no clothes in CeFi, right? All the regulation and all the compliance and all the shiny badges of certificates and stuff that adorn the walls of the CeFi centers don't mean anything at all. And my God, had this been on chain, people would have spotted that 7 billion black hole when it was 7 million. So, okay, I'm calling it really early, but this is massively paving the way for open, on-chain, clear, honest, non-forgeable business on-chain. So quietly or maybe quite audibly, very, very bullish on that.
I'm right there with you. I think this is huge for us. I mean, the FTX example is a great example of regulatory capture as well, which, if the regulators are captured, or, Sam Bankman-Fried is conspiring to make DeFi unusable and regulate front ends and all that stuff, then regulators are not only not helpful, they're adversarial. So I think what you're saying makes a lot of sense. I mean, this is really great for decentralization, and I think this is a great example of proving our point, so to speak. So that's very exciting. One thing I did want to touch on is that you mentioned there's like some sort of CeFi integration. Now that seems pretty interesting, sort of to bridge the DeFi and CeFi world with a protocol like yours. Without going into too many details or who the exchange is or anything like that, what is the hope down the roadmap about an integration like that?
Yeah, I can touch base on that because I also had a speech a few days ago to an event about CFI DeFi relation, and something that most of the people that realize in the space is that actually DeFi, it's, I will call it like synergetic, or it's very related to CFI because of like, for example, when we trade with market makers, what they do, they just take the other position on centralized exchanges, and it could be Deribit mostly because we can do the name. And so like, well, one of the point that we were discussing then is like, how can we actually create a product that it doesn't have to rely on CFI too much because of everything that happened, right? I mean, we all know that Deribit, that's solid, at least that's what we think, but I thought the same from FTX, to be completely honest. And so I'm like, I don't know what's gonna happen in the future, right? And so we said, let's say if Deribit goes down, like most of the products in DeFi, especially when it comes to option, they probably they stop trading because most of the market makers take the other position there, because most of the liquidity coming to DeFi, it's actually related to CFI activity. And so one of our goal there, like right now, we are dependent from that as well, because we use market makers, because we have a bunch of whales doing arbitrage, and what they do arbitrage between Deribit and us. That's how it works. And so one of the goals is like, how can we actually build an ecosystem that is within DeFi? And so instead of harping from Deribit, why not harping between us and Lyra, for example, or you can harp between us and whatever other product. And based on that, to be honest, I'm also very bullish on, like Ribbon is working on this new, I think it's called Evo product, that it should be like some sort of order book for options, for example. So I'm very bullish on any product within DeFi that is actually bringing, more liquidity, and it makes DeFi interacting each other instead of using CFI. Because as I said, like I'm a big fan of Deribit. I've been trading on Deribit for years now, and never had an issue. And I hope never is going to happen to them. But as I said, like I had the same feeling with FTX, right? But something happened. And so I think the most critical challenge for us as, DeFi builders in the option space, it's to bring liquidity into DeFi and make this market maker, for example, harping between different DeFi protocols, using something like the new Evo product as an order book, and so on. So I think that's the biggest challenge that we should face. But as you said, right now we are, like as an industry, dependent from CFI. That's how it is.
Very cool. So just kind of wrapping up here, what are some things that like if I want to learn more about Rysk or trade on Rysk, like what are some avenues for me to follow you guys? Is it Twitter, YouTube? What's your website? If you don't mind just kind of plugging that stuff, and we'll link it into the show notes as well.
Yeah, so the website is Rysk, Rysk.finance. So that's the main source of information. You have the docs there, you can deep dive, you have the GitHub, then you can see all of our code that is open source and everything. Right now, as I said, we are on alpha. So if you anyone want to play with the alpha, test the alpha, and play around with it, you can basically join the Discord and just ask for the alpha and say that you're coming from this podcast, and that will give you access basically. Because of the alpha, as I said at the beginning, like we know that there is some risk and we wanted to test the infrastructure. We said, if you decide to use it, you have to be, some sort of type of user that that is going to be a risk there. So that's why we like to know users and make sure they understand that, because playing with options, it could be risky. Let's put it this way. But yeah, like our website, rysk.finance is the main source. And then we also use Twitter quite often. And handle is like Rysk Finance, and with Rysk as usual with the Y.
Fantastic. And just kind of wrapping up here, maybe on a little bit more personal note, Dan and DeGeneral, 2 questions. What do you guys like to do outside of building a protocol, sort of for fun or leisure? And do you guys have any books to recommend to maybe newer traders who are getting into options that you found useful in your careers?
Yeah, gonna start and then let the general, especially on the book side, the general is the best person I know when you need to ask for a book on derivatives, options, and math and everything. But my favorite book is like Options, Futures, and Other Derivatives. I think it's a very good one because it goes on details like, how the pricing options and, blessed calls and all this kind of stuff. But it's kind of technical, but it's probably the most fascinating part of option to me. Outside of, reading about crypto and options and stuff like that, I'm Italian, so I like to cook, and the general knows that because I've been cooking for them. I like to watch football, and now there is the World Cup, so I'm super excited, but Italy's not there, and so that's a very bad note. And travel, that's pretty much everything. But, recently mostly just been around DeFi, and that's probably the biggest passion, or like where I put most of my time.
That is awesome. And what about yourself, DeGeneral?
Well, starting off with the IRL stuff, I think the IRL for me is DeFi. But what do I do outside of the IRL? I live on a sailing yacht off a volcanic island. And so I'm waiting to get hold of Elon Musk's intergalactic internet at 500 megabits a second, so that I can do DeFi options trading whilst in the middle of the Atlantic. I think that'd be pretty cool.
That is amazing.
I'm quite old school, so as well as coming onto Discord, finding me, I'm called DGeneral, or on Twitter, DGeneral_DeFi, and come talk to me about anything, especially if it's DeFi options. I've got some recommendations for books. So from the quantitative side, that's where I come from, mathematician, and then I got interested in cryptography when I was about 11, and have followed it on since then to PhD. I can recommend, of course, the whole book that Dan recommended. For something even more involved, that comes as a triptych of 3 volumes, is Paul Wilmot's On Quantitative Finance. Excellent, literally does everything from interest rate derivatives down to credit derivatives, down to everything, largely focused on pricing. Pricing and trading are extremely different things. And so from the trading side, I have 2 recommendations. The more practical one, I think, for sort of managing a book of more complicated trades is probably Taleb, that's Nassim Taleb, his Dynamic Hedging, Managing Vanilla and Exotic Options. And then the other one, which is a lot more accessible, and I would recommend that as a first read for would-be traders or traders that trade Delta One products like perpetuals, futures, spots, and tokens that are looking to get entrance into trading options, and a few sort of strategies on how to make money from trading options. As you said earlier, covered calls is one of the strategies he goes into, but there's lots more to it, all quite easy to understand. And that is Trading Volatility. It's Colin Bennett, Trading Volatility, Correlation, Term Structure, and Skew. And it's a very accessible book, and it's got a lot of really interesting and useful strategies that you can try with, a couple of $1,000. You don't need to have millions of dollars to kick that sort of stuff off. So there you are, everything from mathematics down to the truly practical trader.
That is awesome. Fantastic recommendations, guys. Well, thank you so much for coming on the podcast. We really appreciate it. We think it's going to be super educational for a lot of new traders and veteran traders who are now getting into DeFi and looking at a protocol like yours. And to everyone who tuned in, thank you so much, and we'll see you next time.
I've got one more plug.
Thanks, Ryk.
I wanted to ask, and I'm sorry.
Go for it. Let's hear it.
I'm heading out the quant team. I have 2 amazing quants with us. One of them is leaving to complete her PhD. Fully support that, mostly. Except it does mean now that I have only 1 quant. And that means that we're hiring. And so if you are a mathematician, and maybe you've done a PhD, maybe you've done a master's, maybe you've done maths at uni, maybe you're just a prodigy. You find DeFi options super interesting, you know loads about volatility, or you don't know anything about volatility, come and apply to join us. And The very worst that will happen is you'll hear some great brain teasers in the interview, and the very best that will happen is you'll be with us on the desk, dealing OTC options, building mathematical models, and trading systems. So please come and apply.
Fantastic. Oh, and we'll link an email, contact email for anyone to reach out to you directly for that in the show notes, and we'll put something in our newsletter as well. Well, guys, thanks again. Really appreciate it.
Awesome stuff.
Thanks,
That
guys.
was wicked. Thank you so much. Ciao for now.
Anytime. See you guys.
Thanks. Bye.
Bye.